Welcome to On Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what's happening right now in the world of investing and how to build the right portfolio. Now, the Iran-US situation has been going on for over 1 week now, and obviously we've been through a lot of market volatilities. And as a result, we have been getting a lot of questions from our clients, from investors, about how to adjust their portfolio or how to think about what's going to come in the days and the weeks ahead. So I'm delighted to be joined by my two colleagues, global market strategists. First of all, Rasid from Singapore.
Thanks, Tai, for having me.
And Marcella Chow from Hong Kong.
So glad to be here.
So to start, let's maybe take a quick recap of where things are right now in the Middle East. So Raisah, can you start by just sharing with us how are we thinking about the current Middle East situation?
Sure. So, the U.S. Iran war has lasted for a week and a half now. As of now, there's still no visibility on how or when it will end. So the situation is arguably fluid, but we do see a number of factors that could limit the duration of this conflict. Our base case is that this remains primarily a geopolitical event rather than an economic one. And what this means is that disruptions are likely to be measured in weeks rather than months. And what this means is that we are shifting our focus into thinking about the macro implications of the conflict, given if it should be more prolonged, and the clearest channel is through higher oil prices. Now, the Brent future curves, as the chart shows in front of you, suggest that the market is not currently pricing in a prolonged impact of higher oil prices. So that does bring some relief, but what will be useful for us is to map out a scenario as to which crude oil prices could potentially stay higher and what that could mean for Asian markets, which I'm sure we'll get to slightly later.
Well, let's dive into the oil price risk. That's very much the core, the center of this particular conflict and its impact globally, not just in the Middle East and the region, but obviously across the global economy. What do you think? What do you think the price risk is here in terms of oil?
Yeah, so since the Middle East conflict started, we have seen oil prices really surging in recent weeks. But in the last 2 days or so, we have seen some relief, and this is illustrated in the chart, with Brent now hovering about $88 per barrel at the time of this recording compared to where we were at before the conflict began. So that's up about 36%. Now, this comes obviously after Brent crude oil nearly breached $120 earlier this week on Monday, the March 9th, and this is the highest since the middle of 2022. Now, we tend to look at spot Brent crude oil prices, which, as mentioned earlier, now stands at 88. But what will be useful, as mentioned earlier, is to look at the future contracts to really get an insight as to where markets are thinking oil prices will land. And if you just look at the June contract number, for example, it is about $85 per barrel. While if you look at the December 2026 contract, it is at about $75 per barrel. And this tells us that markets are on the same page in thinking that this could be a more short-lived sort of conflict. Naturally, when energy prices rise quite sharply, this does fuel worries over stagflation, which is obviously an environment where we're seeing high inflation and weaker growth. But besides tracking the number day-to-day basis, I think what's really more important is the duration of the spike. Now, recall that the last time we've experienced any sort of this environment was back in 2022 with Russia's invasion of Ukraine, where oil prices hovered above $100 per barrel for about 6 months. And now this came on the back of that when global economy was still reeling from the pandemic. And that's when we saw that bitter memory of that broad sell-off across both equities and fixed income. But given our view for a more short-lived episode, that still is not our baseline case as of now.
So, Raisah, you mentioned earlier that you expect this particular conflict to be lasting in weeks instead of months. What are some of the reasons behind that? And also, what are some of the signposts we're watching out for in order for this conflict to reach a slightly more stable point?
Yeah, I think it is a tricky question right now. So far, we have seen the U.S. administration being rather vague in terms of the objectives in its conflict with Iran, which makes the tracking of the future path of military action more challenging. But in terms of the parameters that we're looking at, I think there are three. The first one is munitions in terms of the volume of launches and defenses. Second is markets, and the third would be the U.S. midterm elections. Now, on the second and third point, we know that events over the past year have showed us that the Trump administration tends to be very sensitive towards market volatility. and public sentiment. And when you contextualize the fact that the US will be heading into a midterm elections in November of this year, it becomes particularly challenging for this case to be prolonged, and hence our base case that it would be weeks rather than months. So I think on that, we kind of look and focus a lot more on the manifestation of the conflict rather than the conflict itself. So we're looking at what does this do to oil prices, and with that, questions around, do countries have sufficient reserves to withstand this period of uncertainty? How will policy makers respond to this shock? And those are the questions that we're constantly discussing even within our team.
Thanks, Raisah. So I think just to quickly summarize, we do think this conflict, obviously from a humanitarian perspective, is terrible. But from the perspective of politics and the calculus from Washington, munition, market performance or market reaction, and also the upcoming midterm elections are going to be really important determinants of how long this conflict could continue. And obviously then that translates into energy prices and broader economic implications, at least for the time being. The futures markets telling us that they do also expect quite a quick resolution, or at least quite quick stabilization when it comes to this particular conflict. Now, Marcella, I think the last week and a half, again, we spent a lot of time discussing the oil market, and one of the key aspect of this is the role of the Strait of Hormuz, which is very much a key choking point for oil transportation, really from Gulf states into the global markets. Maybe to start, can you explain why is the Strait of Hormuz so pivotal right now?
So although Iran accounts for roughly 4% of global crude, and OPEC Plus likely has spare capacity to cover moderate shortfalls, as we see on the right-hand side chart of the current exhibit, the Strait of Hormuz is a major choke point for energy flows, like you said, and any potential closure could affect 38% of global seaborne crude, 20% of global crude oil supply, 17% of global LNG, 3.5% of container volumes, and 2% of dry bulk. Many Asian economies like China, South Korea, Japan, India rely on energy transiting through the Strait of Hormuz, even though strategic reserves can buffer short-lived disruptions. South Korea and Japan, for example, have over 6 months of reserve, while Taiwan has 3 to 5 months. China's reserve is around 1 to 2 months. And in the case of any oil shipment suspension from the Strait of Hormuz that lasts for weeks or months, China will probably have to fall back on alternative oil sources in the short term and rely more on its coal reserves, as well as developing sustainable energy in the medium term. A prolonged disruption may also affect technology supply chains due to the energy needed for like data centers and chemicals used in semiconductors and memory. Asian governments are already deploying fiscal policies like capping fuel prices to help ease the pressure on businesses and consumers, naturally raising fiscal deficits. The choking point of Strait of Hormuz, to answer your question, will likely threaten to disrupt trade, push up shipping costs and insurance premium, as well as to test the supply chain of LNG and also petrochemicals. Meanwhile, the disruption to shipping in the Strait of Hormuz is now also putting serious strain on oil storage capacity in the Gulf. As Hormuz shipping flows remain severely restricted at the time of recording, this forces production shut-ins as storage fills. Iraq, according to news sources, has cut output sharply, while the United Arab Emirates and Saudi Arabia are managing or reducing production amid limited bypass capacity. So even with de-escalation, restoring full output will still likely take several more weeks.
Great, thank you, Marcella. Raisah, let's come back to you. In terms of the impact on Asian economies or APAC economies and the policy response, what's likely to be the impact, especially coming from higher oil prices?
So if higher oil prices do persist, most Asian economies will likely witness downward pressure on growth through negative thermal trade shock, along with higher inflation. If you look back in 2025, we did see that net oil and petroleum imports only averaged about 2% of GDP across all of Asia. Energy takes up a modest share in Asia's CPI basket. So unless the oil shock does not turn out to be transitory, we do expect that there will only be limited impact on growth and inflation for Asian economies as per our base case. But again, what we want to do is to build a blueprint to navigate the alternative scenario in which that this could drag out. So what would be useful is to look at the main channels as to how oil prices could affect Asian economies. And the two main channels are CPI and trade balance. Now, on inflation, we estimate roughly only about 0.2 percentage points increase in headline CPI across Asia for each $10 increase per barrel in crude oil prices. But obviously, there are nuances. There are some countries with larger sensitivities, such as India and Indonesia, given the higher weight of food and energy in their CPI basket. Now, developed Asian economies such as Japan, South Korea, they are expected to see a little bit more of a modest impact. Now, 2 points to be made over here. First is that some countries in Southeast Asia do have fuel subsidies in place, and this could mitigate the impact on consumers. Second, given that there is a tight correlation between food and oil prices, which both in total does take a significant amount in the CPI basket, we could see some temporary supply shock as we see the adjustments in crop prices to retail prices. Now, second channel is the trade balance. Almost all countries in the region are likely to see a deterioration in their current account balances, particularly those that are highly dependent on imported energy like oil, petroleum, and gas. These countries that come to mind would be Thailand and South Korea, as you can see on this chart. Now, the countries that are net crude oil exporters, such as Indonesia, for example, could be slightly better off, but all in all, current account compression could be on the cards should this be prolonged.
Great, thank you. So you mentioned a bit earlier in terms of fuel price control or fuel price subsidies in some economies in the region. What is the likely policy response, both from a fiscal perspective, which the fuel price control is typically a fiscal response, but also from a central bank's perspective, are we running a risk of potential rate hikes in our part of the world?
Yes, you mentioned Tai. Fiscal policy will likely be the first channel of response. In this regard, countries such as South Korea, Taiwan, they do have additional fiscal buffers in comparison to Indonesia, for example, as the chart illustrates. Now, having said that, energy-driven inflation in Asia is likely to remain limited still, given that, as mentioned earlier, we do have fuel price smoothing mechanisms in place, and we do expect that this scenario should be quite short-lived. And while this protects domestic demand in near term, it does shift the burden to sovereign balance sheet, and this could potentially widen fiscal deficit, especially in the alternative scenario that prices remain elevated over an extended period of time. As Marcella mentioned earlier, we have seen some policymakers taking steps to shift the focus on the consumers and how to make sure that the standard of living is not too much affected, and how they're shifting away from industry use of some of this oil and focusing a lot on consumers. We have seen some countries in Asia applying curfews to limit the use of electricity consumption. Again, I think this goes back to the very first point that we made earlier. It is about the duration of this risk, particularly around oil prices. On monetary policy, this is where it gets a little bit more interesting, because right now we are seeing central banks on alert. They are watching the inflation risks more closely, but typically most central banks will likely look past through an oil price jump, given that this is a supply side shock in nature. However, should financial stability be challenged, say through FX, we could see some stepping up in monetary policy actions, and this could result in potentially a monetary policy rate hike. Again, this is not our base case, but this comes into question, especially if the balance of payment may come under pressure, absent offsetting capital inflows, as we see a compression in the current account. But all told, should the price increase be modest, the region's structural features that are in place, the policy framework, should at least soften the impact of this one-off surge in global energy prices.
Great, thank you, Raisah. So I think again, coming back to the key point here is the duration of oil price or energy spikes is going to be the key. The good news is both in terms of oil reserves, but also fiscal buffer, some of this impact or the negative impact could be absorbed, at least temporarily, by government spending as well as subsidies. But at the same time, central banks will be more watchful over the inflationary impact, especially for selected economies that could see more FX volatilities. That's very much the reasons why central banks hike rates, not just to slow growth, but more importantly, stabilize their foreign exchange rates. So we've gone through the situation in the Middle East as well as the importance of the Strait of Hormuz. as well as the potential impact on Asian economies and policy response. Of course, let's come back to the most important part of our conversation, which is what does that mean for markets? What does it mean for investors? So, Marcella, could you share with us your thoughts on the market implications of everything that's happened in the past week and a half?
Sure. So in terms of equity, we saw that Asian equity market sells off and past week have been pretty broad-based and indiscriminate. For Northeast Asian indices, over 90% of companies were down last Wednesday and also on Monday across Korea's Kospi, Japan's Topix, and also Taiwan Stock Exchange. This likely to be powered by passive index tracking strategies, and in some cases like Korea, the leverage variety of passive strategies. This means quality companies that are less exposed to the current market volatility or with good long-term earnings outlook are also sold by investors this time around. This would argue for opportunities for active managers to hold on to companies with good medium to long-term prospects and maybe add on dips. And given the potential for still elevated equity volatility going forward, option overlay strategies could help investors generate income from market fluctuations. Covered call strategies can help monetize volatility, providing additional income while also retaining equity exposure. In addition, we view the structural drivers for North Asian equities remain intact. Hardware supply demand dynamics should stay tight through the year and potentially into next year. Japan and Korea also benefit from structural improvements in terms of corporate governance reforms.
Yeah, and I think this is really important for everyone to remember is that a lot of these volatilities tends to be temporary. The question is how can we manage our portfolio in a way that can deal with these volatilities, but also don't forget the longer term prospects when it comes to growth, whether it's in terms of AI, hardware demand for Northeast Asian economies or more broader growth momentum that we see across the APAC region. And then just to bring everything back to the whole portfolio construction, Marcella, how should we respond when it comes to portfolio construction?
When oil prices remain elevated, the market concern is the high inflation that might persist. And inflation environments typically challenge fixed income because central banks become more cautious about rate cuts. And even traditional safe havens like gold have faced headwinds from dollar strength and higher rate expectations. So Japanese yen as well has not shown its traditional safe haven behavior, given Japan's own market and also fiscal dynamics. U.S. Treasuries, which typically also act as safe haven assets in such an environment, have also actually seen yields move higher, as this chart shows. This is likely due to the prospect of high oil prices that can raise inflation expectations while challenging the narrative for Fed rate cuts. Extended military action could also add pressure to the U.S. fiscal position. Meanwhile, U.S. dollar has actually seen some strengthening, which is a classic risk-off flight to liquidity behavior, with investors seeking safety amid geopolitical uncertainty. And the mechanics are actually quite straightforward. High oil prices reduce the probability of rate cuts, which supports the dollar. It's not that investors are suddenly more bullish on U.S. assets, but then the U.S. is relatively insulated as a net petroleum exporter. So we continue to believe that the dollar could ultimately weaken, and uncertainty around midterm elections and potential policy shifts could erode U.S. asset appeal over time, though we don't see a credible near-term challenge to dollar dominance. And from an asset allocation perspective, investors could look at real assets like transportation, infrastructure, which could present resilience during all the ongoing geopolitical tension. The consistent message is stay diversified, reduce concentration risk, and consider alternatives to build portfolio resilience. Markets historically recover from geopolitical shocks relatively quickly, unless they morph into a prolonged growth shock, which is not our current base case.
Great, thank you, Marcella. I think many of these investment principle continues to be absolutely critical. As Marcella mentioned, stay diversified, and obviously stay invested, because if you look back to many of these historical geopolitical events, what you typically see is in a 1 year and a 3 year time horizon, a 60-40 stock bond portfolio typically will outperform cash. So while I can understand investors may feel quite anxious with headline news flying in and out every day, the reality is the global economy continues to hum along. We remain optimistic about the U.S. economy in 2026, and the fact that the Federal Reserve is not rushing to cut rates, I think is very much a testimony to that. But at the same time, corporate earnings continues to be a key underpinning factor when it comes to equities as well as generating returns. So while, again, there's a lot of noise in the markets today, I think the really key message for everyone, whether it's APAC investors or global investors, is to stay diversified as well as stay invested. So thanks for joining us today. If you find it useful, please consider subscribing, and of course, recommend this to your friends and colleagues. And please reach out to your JP Morgan Asset Management client advisors if you have any additional questions for us. I'm Tai Hui, joined by Marcella and Raisah, and thank you again for your time, and stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only, based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given, and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.